Hi everyone, I'm Sidney Mckinnon, MD and CIO of Cadiz Asset Management, and welcome to our channel once again, where we speak about all things fixed income. Today I'm going to be talking to you about constructing your fixed income portfolio. But before I get to the construction side of things or putting it together, let me first talk about investing in anything, just about anything. If you want to create a portfolio for investment, I think the first thing is the basic principles that apply. And those basic principles effectively stretch over issues such as, what am I aiming for? What do I actually want out of this investment? What is my objective? What is my goal? What is my target? Do I just want liquidity? In other words, the ability to put funds somewhere and be able to take that out quickly again? Or do I want to make it part of a larger portfolio where I need some diversification by getting involved in a fixed income portfolio? Or do I perhaps need a portfolio that's going to protect my savings over a longer term? So there's a time horizon that's involved in terms of when I would need my funds. Or do I need my fixed income funds to provide me with an income stream over a particular period of time? So there's all these facets that I think one is to consider before you even get to the stage where you construct or put a portfolio together. So I'm sure with the experts that you have, you can talk through those issues, because each and every person's or each and every individual's circumstance is different. Each and every person's risk profile is different. And one is to consider all of these things when constructing a portfolio. So let's look at it from that premise and from that base. When you construct a portfolio, any portfolio, in this case we're talking about fixed income portfolios, how you would actually put it together based on those fundamental and basic principles of investing and putting a portfolio together. So first of all, let's look at the fixed income landscape and what you can invest in. And I think we may have spoken about this in previous episodes, but if you look at the fixed income landscape, it's quite a wide landscape. At the low risk end of the scale, or the bottom end of the scale, you will have investments such as fixed deposits or merely putting your money in the bank account. That's a fixed income investment because it provides fixed income returns and it gives you interest. Or you could put your money on fixed deposits. You could move slightly further up the spectrum and invest in other money market instruments such as negotiable certificates of deposit or treasury bills or even corporate or credit paper related to that money market arena. And let me just pause there for a second, because that is the first building block of a fixed income portfolio, and that forms part of your lower risk or lower end part of that portfolio that you would like to build as a fixed income portfolio. That money market environment, which encompasses instruments such as deposits, money in a bank deposit or on deposit, money on a fixed deposit, or money that's invested in perhaps in a negotiable certificate of deposit. That forms that front end, that lower risk end, and generally the time horizon for constructing that low end of your portfolio is around about 1 year. That's the premise and the norm. Could be longer, but that's the norm that's within the environment, financial market environment at the moment. The next part that you can get involved in, or the next sector that you can get involved in fixed income, is obviously bonds. And we've spoken about bonds before. Here is an asset class that is pertinent to providing you with income streams on a regular basis through coupon payments. You'll see it in the form of interest payments. And as mentioned before, this income stream for bonds has a great degree of predictability of your income stream through the coupon payments that you will receive. However, it's a little bit more risky, or riskier than your basic money market or low-end fixed income investment such as a bank deposit. Riskier in the sense that it could actually rise in value depending on the directional movement of interest rates, or decline in value depending on the directional movement of interest rates. So that's another sector, but of course a very important, because I'm a bond fund manager, I'm a bit biased. I think actually every home should have one in your entire investment portfolio. We could go further down the scale into slightly more riskier assets such as corporate paper and credit-related paper to make up the entire spectrum of constructing your portfolio. But all good and well. how do I gain access to these instruments and how do I put this together? I think I'd like to take you back to the first point I made, is that everybody's circumstance is different. So consider the fact, do I need low risk investment, absolutely a low risk investment, where I need liquidity and I need to get my money out of this investment very quickly and easily, yet I want the fixed income benefits, or the benefits of being invested in a fixed income portfolio. Then the lower, you have to weight your portfolio towards that lower end of the fixed income spectrum. But if I've got a longer time horizon and I can stomach higher risk than your basic deposit in the bank, then the bond environment might not be such a bad idea, and you can allocate some of your exposure to the bond environment. And if you even would like to gain a little bit more yield on top of what you can get from merely being invested in your lower risk, because remember, being invested in the lower risk of the fixed income spectrum will reduce the yield that you can obtain from such an investment. Like all investments, your higher the risk, the higher the reward over time. And I think I've got to stress that over time, because very often your fixed income investments or money market investments are thought of as short-term investments. They could very well be, but in order to get the full benefits of such an investment, you have to be invested over a period of time, whatever that time horizon is, based on your personal needs and risk profile. So when you construct that portfolio, you can take all of those factors into account so that you can put together a portfolio that is pertinent and that matches your goals and your needs. Your fixed income portfolio could be very well part of a larger investment portfolio that would contain other asset classes as well. But for the fixed income side, I think those are the important things that you need to consider. I think also the important thing is, how do I gain access to it? How do I buy corporate paper? How do I buy a bond? And I think the easiest for everybody, and dare I use the phrase, the man in the street, I don't like using the phrase, but for the layman to get involved in it, is through your collective investment schemes or unit trust. Because here you have vehicles where it's been managed by the experts, and you can buy units in those schemes that give you the exact same exposure that you would get if you would try to do it on your own. So a good point is to let the experts do it for you. Take that tip, let the experts do it for you, and then you can get the benefit of constructing a portfolio that matches, a fixed income portfolio that matches your needs. I thank you for watching. Next time we'll talk about another topic, but stay tuned. Until next time, goodbye.